Hi. Let's learn about corporate bonds. A corporate bond is a type of debt security issued by a corporation and sold to investors. The company gets the capital it needs and in return, the investor is paid a pre-established number of interest payments at either a fixed or variable interest rate. When the bond expires, or reaches maturity, the payments cease and the original investment is returned. The backing for the bond is generally the ability of the company to repay, which depends on its prospects for future revenues and profitability. In some cases, the company's physical assets may be used as collateral. In the investment hierarchy, high-quality corporate bonds are considered a relatively safe and conservative investment. Investors building balanced portfolios often add bonds in order to offset riskier investments such as growth stocks. Over a lifetime, these investors tend to add more bonds and fewer risky investments in order to safeguard their accumulated capital. Retirees often invest a larger portion of their assets in bonds in order to establish a reliable income supplement. Corporate bonds may have a higher risk than U.S. government bonds and therefore have higher interest rates, referred to as the credit spread. Before being issued to investors, bonds are reviewed for the creditworthiness of the issuer by one or more of 3 U.S. rating agencies. They have their own ranking system, but the highest-rated bonds are commonly referred to as AAA-rated bonds, while the lowest-rated corporate bonds are high-yield bonds, also known as junk bonds. Bond ratings are vital to alerting investors to the quality and stability of the bond in question. These ratings consequently greatly influence interest rates, investment appetite, and bond pricing. Corporate bonds are issued in blocks of $1,000 in face or par value, and almost all have a standard coupon payment structure. Typically, a corporate issuer will enlist the help of an investment bank to underwrite and market the bond offering to investors. The investor receives regular interest payments from the issuer until the bond matures, where the investor reclaims the face value of the bond. Corporate bonds sometimes have call provisions for early prepayment if interest rates change dramatically. Investors may also gain access to corporate bonds by investing in bond-focused mutual funds or ETFs. Corporate bonds are a form of debt financing and are a major source of capital for many businesses along with equity, bank loans, and lines of credit. Debt financing is sometimes preferable to issuing stock because it is typically cheaper for the borrowing firm and does not entail giving up any ownership stake or control in the company. A company needs to have consistent earnings potential to be able to offer debt securities to the public at a favorable coupon rate. An investor who buys a corporate bond is lending money to the company and is paid in interest rather than profits. The original investment can only be at risk if the company collapses. Companies may also issue convertible bonds, which are able to be turned into shares of the company if certain conditions are met. On the other hand, an investor who buys stock is buying an ownership share of the company. The value of a stock rises and falls, and the investor's stake rises or falls with it. Here are 4 key takeaways. 1. A corporate bond is debt issued by a company in order for it to raise capital. 2. An investor who buys a corporate bond is effectively lending money to the company in return for a series of interest payments, but these bonds may also actively trade on the secondary market. 3. Corporate bonds are typically seen as somewhat riskier than U.S. government bonds, so they usually have higher interest rates to compensate for this additional risk. 4. The highest quality, and safest, lower yielding, bonds are commonly referred to as AAA bonds, while the least creditworthy are termed junk. Hope this would help. Thanks for watching.